It is Monday, which also means we're going to go back into the ToddCast Time Machine.
It's a ToddCast Time Machine.
Do I need to do a right? I don't know. If you guys have, I hope you like our little music interlude on this. You should know that the inspiration I was looking for was sort of Huey Lewis meets, without having to pay Huey Lewis rights for, Huey Lewis adjacent, to give you the vibe of Back to the Future. So the ToddCast Time Machine is actually got a financial theme to it. I figured, we're talking a lot of things having to do with money, the economy. Well, on October 19th, 1987, that's where we're going back. It's now called Black Monday. That was the day that the U.S. stock market lost 22.6% in a single trading day. It was one of the most sudden and alarming crashes in financial history. And today, as we move into October 2025, we're in the middle of it with a lot of people wondering, how bubblicious is this AI-driven stock market, right? It's worth re-examining the moment and asking, could history teach us anything relevant for this market? And what risks lurk in 2025 that echo 1987? And are there safeguards that are missing? I have to tell you this, we have a lot of safeguards today because of the 1987 black market. But here's what you need to know about how it happened. And I'll just be honest, that 87 crash, I was 15. My dad would die 14 months later. He was a modestly successful financial advisor. Needless to say, all his clients lost a lot of money that day. Whatever savings my parents had were gone that day. Never recovered at that point, and led to sort of. So it has always been it was sort of, I've always pinpointed it, even though my dad had not been diagnosed yet, always have pinpointed it as sort of the beginning of the end for my father. So there is for me, this is both personal and certainly had an impact on how I think about markets and how I think about the economy and how I think about what you think of the stock market and how much you should react, underreact, overreact, etc. But let me give you sort of a larger look at what the economy was looking like back then. In mid-87, the market had already been running up big time. Valuations were stretched. Growth was decelerating while inflation and interest rates were starting to rise again. Yet international currency was a contributor to this one. The 85 Plaza Accord, which sought to push the U.S. dollar lower, that had a contribution there. And by 87, markets were uneasy about the coordination under a follow-up accord called the Louvre Accords. And what was interesting is that in the week leading up to the crash, it was a crash happened on a Monday. Markets had already been seeing some sharp decline, so there was definitely pressure to sell. More and more were thinking about selling. So when you look at, when you look back in history, the biggest structural culprit to the sort of to this crash was something called portfolio insurance or dynamic hedging. This was sort of the first iteration of computer-based programs that automatically triggered trades. So as prices fell, it automatically increased short positions, i.e. futures that were then to hedge, and it effectively was selling into a weak market, and it would sort of ballooned on itself. It triggered all sorts of horrible feedback loops, falling prices, more hedging, more selling, more downward pressure, more hedging, right? And it was the first time we were warned of what happened when you start to attempt to automate certain trading decisions, right? You automatically buy if you see a number here, or automatically do this if you see a number there. So all of a sudden, quickly, liquidity and got stressed immediately. Some stocks even opened late. They were halted. Sometimes bids disappeared because, remember, some things were computerized, some things weren't. And then the structure of the market couldn't absorb all the orders. I mean, it basically, if you think about what happened in October of 87, and the movie Trading Places, when those guys are on the floor, when everything's panicking and they're having heart attacks, sell, and the whole frozen orange juice concentrate business. If you can imagine that, that's kind of how it looked there. And that's still the way trading was done on that floor. It certainly led to a lot of safeguards being put in. But the crash, interestingly about this crash, is it wasn't rooted in sort of a singular catastrophic macro shock like the collapse of Lehman Brothers, right, in the Great Recession. There was no war. There was no overnight debt crisis. The ferocity came simply from the market's fragility, leverage, and mechanical strategies, right? It was a bit over leveraged. Trust me, as a kid, I knew that it was a triple witching Friday. It was something like when Option Friday coincided with a report. I can't remember what all of that lingo meant, but I know it would make my father's mood either good or bad, depending on the situation. Let's just say he never had another good mood after that. Again, there's a reason results matter more than promises. Just like there's a reason Morgan & Morgan has become America's largest injury law firm. For the last 35 years, they've recovered $25 billion for more than 500,000 clients. It includes cases where insurance companies offered next to nothing, short of shortchanging, seeing if they could get away with it. And Morgan & Morgan fought back, and they won millions. In Pennsylvania, one client was awarded $26 million. It was a staggering 40 times the amount that the insurance company originally offered. That offer, $650,000, whatever it took to sort of get away without paying. So with more than 1,000 lawyers across the country, Morgan & Morgan knows how to deliver for everyday people. So if you're injured, you're looking for a lawyer, check out forthepeople.com/Toddcast or dial pound law, pound 529 on your cell phone. And remember, all law firms are not the same. So give Morgan & Morgan a look. Their fee is free unless they win. The good news about that crash is that because it was essentially a mechanical crash, is I guess the way to put it. It didn't provoke a broader banking crisis, right? There wasn't a run on banks like we had during the Great Recession. And we didn't end up in a deep recession, unlike 2008 or even after 1929. Believe it or not, it took only 2 sessions after the crash for the Dow to claw back 57% of its drop. The market fully regained its prior high by early 1989, less than 2 years later. And then afterward, regulators and exchanges added mechanisms like circuit breakers, trading halts to slow panic in future crashes. Look, it was the first lesson I ever got, which was, hey, don't panic. Close your eyes. If you're younger, close your eyes. Eventually, the market is going to come back, because the market always, you can see it, right? There's always this upward trajectory, and in some ways, many people behave that way anyway. Now, the question is, where are we sitting now, right? Is this a bubble? Do we only have, right? The S&P 500 keeps going gangbusters. The Dow, not so much, right? There's all sorts of things that could be happening here that we're not quite 100% sure of, right? Why are the large stocks continue to go up? Is this all due to AI investment? How much of this is due to people who are sort of heavy into crypto? It got essentially legalized by the government, and they've quickly got out of crypto and then bought Microsoft, Google, all the large cap stocks in order to take this imagined money and turn it into a real asset. We shall see. But there's certainly a lot going on in this market that, for those that are not experts in it, are wondering, are you sure you're not missing something? Are we sure this isn't a bubble? Are we sure we're not going to end up in a situation like what we saw in 2008 or what we saw in 1987? In 2025, so the question is, what parallels are out there? Well, we do have an algorithmic parallel, right, that you could be there. Markets are even more dominated by algorithmic trading, quant strategies, and AI and models. And it raises the risk of algorithmic collisions or systemic feedback loops. We supposedly are constantly looking to make sure this doesn't happen again, but so much is automated. Remember, we had that flash crash. This is probably about 8 years ago now, which we had that 1,000-point drop out of nowhere because of a glitch in one of these automated things. And so you can't help but wonder. And then of course, there's the fact that could a nefarious actor hack into one of these large private equity funds and sort of trigger a flash crash of some sort, right? And trigger a market collapse, essentially by redoing an algorithm. I think there's a lot of things here that we ought to be worried about. The other parallel is the sort of concentration risk, right? In 2020, so far this year, valuations in certain sectors, particularly AI and tech, are under a ton of scrutiny. Central banks are warning about overvaluation, structurally fragile markets. The equity markets are increasingly concentrated, meaning it's just a few big mega tech names that carry outsized weight, right? If Palantir and NVIDIA are somehow, exposed to be something that they're not, and I'm not implying that they are, right? But if they somehow were, the contagion of something like that, right? It would impact your Microsofts. It would impact Google. It would impact Amazon. I mean, the contagion effect of this is something that you do have a lot of people worried about. And then, of course, the other part of this is something we didn't have in 87 that we do have today, concern about the politicizing of the Fed, which could manipulate markets, which in turn could cause cause a crash. Now, some of the differences, right? Why 87 is not really a corollary to 2025. Market infrastructure is a lot more mature. We have a lot more exchanges that are resilient. There are more circuit breakers in case there are halts that are baked in case we do have a flash crash, in case an algorithm does go haywire. Information is a lot more transparent. It's a lot more real time. Every investor has more tools at their own disposal. That's both good and bad. It means everybody could make their own run on a bank. You don't have to go find a trader to do it for you. And in some ways, because the markets are so global and so interconnected, that in many ways we all either rise and fall together, right? It's not as if this would be an American problem and it wouldn't be a problem everywhere else. In a weird way, if we're all in it together, is that a good thing? Or will we somehow take the blame if we somehow bring down the world economy? But either way, that's the Wayback Machine, 1987, Black Monday. It has a particular resonance for me because it was for me sort of the beginning of the end for my father, and for a variety of reasons. But it also taught me some lessons about the market. There are people that were close to my father who were very angry about how the market acted that day, and not paying attention to the fact that if they had just taken a breath, they'd have been in a better place 2 years later than they were on the day of the crash. And it's something I've learned over the years. Never panic right away when it comes, if you're investing money, is don't invest money you need right away. If you're investing money, it's just that. Let it do its work. And the long-term rise, there's always going to be volatility in the middle. And you've got to, if you're invested soundly, the volatility should be in some ways minimized. Sometimes the worst thing we have these days is it's too easy to follow all of this, right?